Everyone blames the landlord for high rent, and it makes sense. They're the only ones you can actually see. But here's what nobody talks about. Your landlord didn't create this problem. They're stuck inside it too. And the real reason rent feels completely out of control in most cities has nothing to do with individual greed. It has to do with a system that quietly changed how housing works, long before most people even noticed. And once you understand it, you realize something uncomfortable. The problem isn't who you think it is. Let's start with a number. In 2024, the average American renter spent 30% of their income on rent. That's the widely cited affordability threshold, the line financial planners say you shouldn't cross. Except, in cities like Miami, Los Angeles, and New York, the median renter is now spending closer to 40 to 50% of their income on rent. That's not a housing market. That's a hostage situation. And the narrative being sold to you is simple. Greedy landlords raised rents. Greedy developers won't build. Greedy corporations bought up all the homes. And while none of that is technically wrong, it's spectacularly incomplete because it ignores the upstream system that made all of that behavior not just possible, but mathematically inevitable. So here's the question nobody's actually asking. Why can't the housing market correct itself? Why, when demand slows down and listings pile up, like they did in 2023 and 2024 in dozens of markets, do rents still not fall? Why does the normal supply and demand logic that works for literally every other product in the economy seem to have a glitch specifically in housing? The answer starts not with your landlord. It starts with a concept called the cost of capital. And more specifically, it starts with interest rates. Meet Sarah. Sarah is a real estate developer, not a villain, not a hedge fund, just a person who builds apartment buildings. Sarah wants to build a 200-unit apartment complex in a mid-sized American city. The cost to build that project, land, materials, labor, permits, comes in at around $50 million. To fund it, Sarah goes to a bank and takes out a construction loan. Now, here's where it gets interesting. In 2021, that construction loan cost Sarah roughly 3.5% in interest annually. Her monthly debt service on the project, the amount she owes the bank every month before she makes a single dollar of profit, is about $225,000 a month. To cover that, break even on operations, and still make a return that justifies the risk, Sarah needs to charge roughly $1,400 per unit per month, which, in 2021, was competitive. So, she builds. Fast forward to 2024, same city, same project, same 200 units. But now her construction loan costs 7.5% in interest. Her monthly debt service has jumped to over $350,000 a month. And to cover that, and still make the project financially viable, Sarah now needs to charge roughly $2,200 per unit per month. Same building, same land, same city. $800 more per door. Not because Sarah got greedier, because the cost of money doubled. And here's the brutal irony. At $2,200 a month, Sarah's project might not pencil out at all, because the local market can't support that rent. So Sarah doesn't build, the project dies on a spreadsheet. And the 200 units that would have added supply to the market, they never exist, which means demand keeps outrunning supply, which means your existing landlord, the one you're blaming, doesn't need to lower rent, because there's nowhere else for you to go. This is what economists call the construction financing trap, and it's one of the most important things happening in American housing right now. When interest rates rise, the cost to build rises. When the cost to build rises, fewer units get built. When fewer units get built, supply stays constrained. And constrained supply with persistent demand means prices don't fall, even when the economy cools. The Federal Reserve raised interest rates 11 times between March 2022 and July 2023, and every single hike made it more expensive to build housing. They weren't targeting the housing market, they were targeting inflation. But the collateral damage landed squarely on anyone trying to find an affordable place to live. But interest rates alone don't explain the whole story, because even when rates eventually come down, and they will, there's a second structural trap that will keep rents elevated, and this one is older, quieter, and more insidious. It's called exclusionary zoning, and it is the single most effective wealth transfer mechanism in American history that nobody talks about. Here's how it works. After World War II, as the suburbs exploded, local governments across America quietly passed laws dictating what could be built where. And in the vast majority of residential land in the United States, we're talking roughly 75% of all residentially zoned land in major metropolitan areas. The law says you can only build one thing, a single-family home. Not apartments, not duplexes, not townhouses, just one house. This sounds boring. It is, in fact, extraordinarily boring, which is exactly why it has persisted for 70 years without serious political resistance. Because nothing kills outrage faster than zoning ordinances. But here's what that boring law actually does. It takes the majority of urban land in America completely off the table for multifamily housing development. It structurally limits the supply of rentable housing to a fraction of what the market could otherwise provide. And this is the part that should make you genuinely angry, it does so in a way that disproportionately benefits people who already own homes. Because when you limit supply, you inflate the value of existing properties. Every homeowner in a single-family-only zone has a direct financial interest in keeping it that way. Their home is worth more when fewer housing options exist nearby. And they also vote in local elections at significantly higher rates than renters. So, what you get is a political system where the people with the most to gain from restrictive zoning, existing homeowners, have the most political power to keep it in place. And the people who bear the cost, renters, are the least politically organized to fight it. It's not a conspiracy, it's just a very stable, self-reinforcing system. And it has been running uninterrupted since the Eisenhower administration. Now, let's add the layer that actually does have a corporate villain. Because around 2012, something changed. That year, in the aftermath of the 2008 financial crisis, a new type of buyer entered the single-family housing market. Institutional investors, hedge funds, private equity firms, real estate investment trusts started buying foreclosed homes at scale, not one or two, thousands at a time. Invitation Homes, now one of the largest single-family landlords in the country, was backed by Blackstone and bought more than 80,000 homes. Progress Residential, American Homes for Rent. These companies collectively own hundreds of thousands of single-family homes that used to be owner-occupied. Now, do institutional investors own enough housing to single-handedly cause the affordability crisis? No. Their share of the total housing stock is still in the low single digits, around 3 to 5% nationally. Any economist will tell you that's not enough to move the market on its own. But here's what they do that's genuinely damaging. It's not how many homes they own, it's how they price them. Because unlike your individual landlord, who sets rent based on gut feel and what the apartment down the street charges, these companies use algorithmic pricing software, the most well-known being a platform called RealPage. And that software coordinates pricing across thousands of units simultaneously. In 2022, the Department of Justice launched an antitrust investigation into RealPage, alleging that its software was effectively allowing competing landlords to share pricing data and coordinate rent increases in ways that would be illegal if done through a phone call. The lawsuit is ongoing, but the mechanism is simple. When thousands of landlords, institutional and individual alike, are all looking at the same algorithm, telling them the same thing about what rent to charge, the competitive pressure to lower prices disappears. Your landlord isn't colluding with the building across the street. They're just both subscribing to the same software. And that software has one job: to maximize revenue. So here's where it all comes together. And here's the part that should fundamentally change how you think about this problem. The rent crisis isn't one thing. It's a system. And that system has 3 interlocking parts, each of which makes the others worse. High interest rates make new construction financially unviable, which kills supply. Exclusionary zoning makes it legally impossible to build density in most residential land, which also kills supply. And algorithmic pricing removes the competitive pressure on landlords to lower prices in response to market softness, which kills the market mechanism that would normally correct things. And here's the really uncomfortable part. Each of these 3 forces is being maintained, intentionally or not, by a different group that benefits from it. Homeowners benefit from zoning, banks benefit from high rates, and institutional landlords benefit from algorithmic pricing coordination. None of them think of themselves as the villain. All of them are acting in their rational self-interest. And renters, who are younger, more mobile, less politically organized, and less financially invested in the existing system, are the ones absorbing all the damage. The rent crisis is not a failure of individual morality. It's the predictable output of a system that was designed, piece by piece, decade by decade, to protect asset values over affordability. And any politician who tells you they can fix it with rent control alone, or by going after landlords alone, is either lying to you or hasn't read past the first paragraph of the actual problem. The real fix requires changing all three levers simultaneously, bringing down the cost of construction financing, reforming zoning laws to allow density, and regulating algorithmic pricing coordination as the antitrust violation that it arguably is. Will that happen? I'll let you answer that one yourself. And that's what makes this problem so much bigger than housing, because the same forces driving rent higher are showing up all across the economy. They're showing up in home prices, in childcare costs, in healthcare bills, in the growing gap between what a normal life costs and what a normal salary can actually support, which is why even Americans earning over $100,000 a year are starting to feel financially squeezed. Not because they're reckless, not because they're bad with money, but because they're running into the same system from a different angle. If you want to understand why, watch this next.